This audiobook is written and produced by WealthBooks. Imagine waking each morning not to the chaos of market noise, but to a disciplined ritual that transforms your portfolio. By embedding specific behaviors like scanning earnings reports at dawn, setting automated stop-loss checkpoints, and scheduling quarterly sector reviews, you create a blueprint for consistent returns. The power of habit in investing reveals how granular routines, tailored to financial cycles and industry rhythms, unlock compound success over decades. Chapter 1. Market Open Scan Ritual. Every morning, before the world wakes up, Alex slides into their home office chair and reaches for a single cup of coffee. At exactly 7:55 a.m., 5 minutes before the opening bell, he presses refresh on 3 browser tabs. One tracking S&P 500 futures, another showing the US dollar index versus major currencies, and a third displaying a simple newsfeed of top headlines. This is the Market Open Scan Ritual, a tight, repeatable routine designed to clear the fog of overnight noise and set a precise risk compass for the trading day ahead. For many investors, pre-market data feels overwhelming. Futures swoop up and down, currencies swing, and news headlines flood in every second. Alex used to drown in the chaos, refreshing dozens of sites, muting notifications, and still missing the early signals that mattered. One February morning, he overlooked a sudden 0.8% drop in futures after a surprise jobs report, held an oversized position, and watched their account bleed 6 figures before lunch. That painful lesson drove Alex to streamline everything into a 5-minute ritual. First rule: limit your tools. Pick only 3 screens: futures, FX, and headlines. Anything else is noise. Futures tell you how stocks might open. FX reveals international risk appetite. Headlines hint at macro shocks. By focusing on these 3, Alex cut their prep time from 30 minutes to just 5. He even set up browser bookmarks named Futures, Dollar, and News, so he lands exactly where he needs. No hunting, no distractions. Second rule: timestamp your scan. Alex's ritual always starts at the same moment, 5 minutes before open. At exactly 7:55 a.m., a simple timer on their phone buzzes. If he is not at their desk, he knows he missed the window. Sticking to a strict schedule turns a habit into an automatic response. Over time, the brain associates that buzz with action, so Alex doesn't think about what to do next. He just does it. Third rule: assign clear stop points. At 8 a.m., the bell rings, and the scan must end. Whatever is still loading or unseen gets ignored until after open. This hard stop keeps adrenaline from dragging the routine into a rabbit hole of late-breaking tweets and breaking news emails. Alex knows that if something truly earth-shattering happens, it will spill over into the first hour of trading, but it won't derail the calm, prepared state he's built. Next, Alex applies 3 quick checks on each screen. On futures, he notes any move exceeding 0.3%. On FX, any dollar moves over 0.2% against the euro or yen. On headlines, only top-line bullet points. No deep dives yet. These thresholds act as filters. Anything smaller is noise. Anything larger triggers a deeper look after the open. This sharp divide between alert and ignore keeps Alex focused on what truly matters. To further cement the habit, Alex visualized the scan as a mini pre-flight checklist. Just like a pilot runs through a fixed-list fuel, hydraulics, controls. Alex's mental checklist includes futures move, dollar strength or weakness, one big news item. If all 3 read green or acceptable, he taps the desk and moves to their first trade. If any read red, a big move or red flag headline, he pauses to review positions or adjust their watch list before placing orders. Pain point: information overwhelm. To conquer it, Alex unsubscribed from every non-essential alert. No bespoke newsletters. No midnight market gossip. He leverages one high-quality newsfeed that distills market-moving events into 3 bullet points. That way, during their 5-minute ritual, Alex reads only what truly shifts probabilities, never commentary, rumors, or speculation. Another key: ritual reinforcement through accountability. Alex pairs the scan with a quick voice memo. Futures down 0.5%, dollar steady, headline on inflation data. Those 10-second memos live in a folder labeled Daily Scans. Reviewing them at week's end reveals patterns like recurring volatility on Wednesdays or consistent morning dips on Fed days, helping Alex refine thresholds over time. Finally, Alex celebrates consistency. Each evening, he marks scan completed on a simple habit tracker app. No shame for missed days, just a clear visual record that gently nudges them back to the desk the next morning. Over 6 months, Alex hit a streak of 50 consecutive scans, transforming a chaotic morning scramble into a calm, confidence-boosting ritual. By boiling down the pre-market noise into one focused 5-minute routine, Alex turned confusion into clarity and hesitation into action. Listeners can adopt this exact market open scan ritual: 3 screens, 5 minutes, clear filters, and a hard stop at the bell. In the next chapters, we'll build on this discipline, layering in deeper checks, risk controls, and reflective habits to forge an investing framework that thrives on consistency and control. We hope you're finding this audiobook useful. Please give it a like. It really helps. Thanks so much. And now back to the audiobook. Chapter 2: Pre-Earnings Checklist. Each quarter, Michael wakes before sunrise to kickstart his pre-earnings routine, treating it as the cornerstone of his success as a retail investor. With coffee in hand, he opens a custom spreadsheet template that lists every company he follows, a habit he developed after missing a massive post-earnings rally 2 years ago. Today, his first task is to gather the consensus earnings estimate for each ticker A metric, defined as the combined forecast of all equity analysts covering the stock. By locking in these numbers first thing each morning, he anchors his expectations to the market consensus and avoids emotional guesswork under pressure. Next, Michael updates the core fundamentals: trailing 12-month revenue, guidance revisions, and the company's forward-looking EPS projections. He zeroes in on guidance trends. Any upward or downward revision in management's outlook often foreshadows a significant move on report day. By comparing last quarter's guidance change to the new consensus, he crafts an expectations delta figure, which he uses to prioritize his watch list. This simple arithmetic becomes his North Star, helping him identify which companies have the most material information risk. With estimates and fundamentals in place, he moves to the next critical step: tracking the whisper versus street expectations. The whisper number is the unofficial forecast whispered among sell-side desks, often more aggressive than the published consensus and prone to rapid adjustments in the days leading up to the release. Michael subscribes to a premium alert service that flags any sudden shifts in these whisper figures, giving him early warning of analyst sentiment swings. By midday, he dives into qualitative color from both sell-side and buy-side research. He knows that raw numbers only tell half the story. Narrative shifts in analyst reports, like a change in tone on management's credibility or macro headwinds, can spell opportunity or danger. To capture this, he highlights in his template any language suggesting better visibility, downside risks, or conservative guidance, tagging each company with a red, yellow, or green indicator. The final pillar of Michael's checklist is automated alert triggers. He programs his brokerage platform to notify him the moment a consensus estimate is revised by more than 1% and sets price alerts at key technical levels, such as last quarter's high or pre-announcement support zones. This ensures he never misses a beat when markets move on new information and can position orders in advance. Consider Sarah's story. Last April, She spotted a stealth upgrade in whispers for a semiconductor company using a tool that measures the probability of an earnings surprise. Acting on her template's alert, she bought shares at $45. After the company beat estimates by 12%, the stock leapt to $52 and 11% gain in a single session. This one win, driven by her rigid adherence to the pre-earnings checklist, boosted her win rate and convinced her that process trumps prediction every time. By treating the checklist as a non-negotiable daily habit, Michael and Sarah have transformed their earnings season playbooks from sporadic guesses into repeatable actions. Each step locking in consensus, updating fundamentals, monitoring whispers, digesting narrative shifts, and automating alerts builds muscle memory that outperforms gut calls. Over time, this discipline compounds, empowering them to navigate earnings season with confidence rather than chaos. Chapter 3. Risk Checkpoint Discipline. Imagine this. It's Monday morning, and Karen, a seasoned investor, wakes up to find her inbox flooded with market alerts. Over the weekend, one of her holdings, a biotech stock, faced a sudden FDA rejection. The stock is down 35%. Panic sets in, and she scrambles to sell, but it's too late. Karen's portfolio takes a hit she could have avoided if she had one habit firmly in place: a daily risk checkpoint discipline. Risk management isn't glamorous, but it's the backbone of successful investing. Without it, even the best stock picks can crumble under unforeseen volatility. The good news? Building a habit of risk checkpoint discipline is simpler than you think. Let's break it down into 3 actionable steps you can start today. Automate, review, and adjust. Step 1. Automate your safety nets. Imagine driving a car without brakes. That's what investing without stop-loss orders feels like. The first step in mastering risk checkpoint discipline is setting up automated safety nets to protect your portfolio. These include stop-loss orders, trailing stops, and alerts. Take Michael, for instance, a tech-savvy software engineer who dabbled in day trading. After a brutal experience with a sudden stock crash, he adopted a simple rule: every trade must have a stop-loss order. He uses a 10% trailing stop on volatile stocks and a 5% static stop on blue chips. This approach saved him from significant losses during recent earnings miss by a big-name retailer. Actionable tip: pick one rule for your stop-loss strategy and stick to it. If you're unsure, start with a trailing stop that adjusts as the stock price rises. Platforms like TD Ameritrade make setting these orders intuitive. Take 10 minutes today to explore their tutorials. Step 2. Daily review of position sizes. Every morning before the markets open, carve out 5 minutes to review your position sizes. This isn't about obsessing over each holding, but ensuring no single stock or sector dominates your portfolio. Think of it as checking the weather before heading out. You need to know if you're dressed appropriately for the market's mood. Here's a quick example. Emma, a small business owner, had a 40% allocation to tech stocks during the 2020 pandemic. While this was profitable during the early surge, the following year's rotation into value stocks decimated her gains. Now, Emma spends her mornings reviewing her portfolio weightings and keeps no more than 15% in any single sector. Actionable tip: set a simple rule for your portfolio allocation. For instance, limit individual stocks to 5% and sectors to 20%. Use free tools like Morningstar or Yahoo Finance to analyze your portfolio and spot concentration risks. Step 3. Adjust with precision, not emotion. Now comes the part where most investors falter making adjustments. It's easy to get emotional when your favorite stock starts dropping, but a disciplined investor approaches adjustments like a pilot recalibrating a flight path, calmly and methodically. Take David, an experienced investor who swears by his no double down rule. Early in his career, he made the mistake of adding to a losing position in a struggling oil company, hoping for a rebound. Instead, the stock tanked further, and his losses compounded. Now he only adjusts positions based on clear, data-driven signals, like breaking below a key moving average. Actionable tip: write down your adjustment rules and revisit them quarterly. For example, if a stock drops 15% from its peak, I'll sell half my position and reevaluate. Keep these rules visible, whether it's a sticky note on your desk or a note in your phone. Why this discipline works. Risk checkpoint discipline isn't just about preventing losses, it's about freeing your mind from unnecessary stress. When you know you've automated your safety nets, reviewed your position sizes, and established clear adjustment rules, you can focus on seizing opportunities rather than fearing the next downturn. Think about Karen again. After her biotech stock debacle, she implemented these 3 steps. 6 months later, she faced another market shock, a sudden tech sell-off. This time she stayed calm. Her stop losses triggered automatically. Her portfolio allocation cushioned the blow, and she adjusted her positions without panic. Instead of losing sleep, Karen spent that week researching new opportunities. You can have that same peace of mind. Start today by setting your first stop-loss order or reviewing your portfolio allocations. It might feel small, but these habits, repeated daily, create a fortress around your investments, protecting them against the unpredictable storms of the market. Chapter 4. Sector Rotation Calibration. Investors who master sector rotation calibration treat their portfolios like finely tuned machines rather than random stock baskets. They know that economic cycles don't just unfold, they follow patterns investors can anticipate. And by aligning capital to sectors poised to outperform next, they capture outsized gains with surgical precision. This chapter walks through a simple, repeatable monthly ritual: how to read the cycle's pulse, pick the sectors ready to lead, and adjust your weightings without emotional drama or endless screen watching, so you seize momentum, not myths. Each month, at the same calendar cue, the investor opens a fresh spreadsheet or sector analysis dashboard and asks 3 questions. Which sectors are exhibiting strength relative to the S&P 500? Answer via simple ratio charts or ETFs like XLK versus SPY. What macro indicators are flashing? Rising interest rates, commodity prices, or consumer spending? Pick 2 yields and copper. Where have flows been trending? ETFs show whether capital is rotating into energy or tech. Next comes mapping those signals to the 4 phases of the business cycle. In early cycle recovery, industrials and materials often kick off the rally as companies rebuild inventories. In mid-cycle expansion, consumer discretionary and technology frequently lead thanks to robust spending and innovation cycles. As growth matures, cyclical sectors peak, and defensive areas like utilities and consumer staples take over to guard against cooling demand. Finally, in recessionary troughs, investors rotate into bonds and dividend payers until the next upswing begins. To turn this theory into habit, the investor creates a one-click dashboard, 6 ETF tickers representing cyclical growth, technology, industrials, consumer staples, utilities, and healthcare. At the start of each month, they update performance ratios, each ticker versus SPY, and rank them from strongest to weakest. No guesswork, no emotional squabbles. If the top 2 sectors outperform SPY by more than 2% over the trailing month, they boost those weights by 5% each, funded by trimming the 2 laggards by 2.5% apiece. This simple rebalancing rule converts subjective cycle calls into mechanical, repeatable actions. For example, in January 2023, one investor noticed energy ETFs had outpaced tech by 4%, while copper prices were rising and yields were climbing. Trusting the mechanical rule, they shifted 10% from technology into energy. 2 months later, as geopolitical tensions intensified, that move delivered a 15% return in energy versus a flat tech index, proof that disciplined sector calibration can capture unexpected macro shifts. Critical to this habit is a no-questions audit. The investor prints out their sector weight changes each month and files them. 3 months later, even if the pick underperforms, they review the signals. Did they follow the ratio rule? Did macro indicators contradict? If the rules were followed, they move on. No second guessing. This journaling habit overcomes bias. Instead of berating themselves for a bad call, they simply record energy outperformed tech plus E4%, copper plus E3%, yields plus 110 BPS, rule triggered, Mutsu 8 BPS net return, signal proof correct. By focusing on process outcomes rather than hero picks, they neutralize emotions. Here's a quick checklist to cement this habit. Monthly calendar alert titled Sector Rotation Calibration, set for the first trading day of each month. Dashboard template listing 6 ETFs with automated performance ratios. Macro tracker for 2 indicators, e.g., 10-year Treasury yield, copper price. Allocation rule, top 2 sectors, plus 5% weights each, bottom 2 sectors, 2.5% each. Audit log entry summarizing signals, actions, and outcome. Sarah, a mid-career marketing executive, turned this ritual into her secret weapon. She admits she was drowning in analyst calls and Twitter noise. Her portfolio zigzagged. Once she adopted the calibration habit, she slept better, knowing her allocations followed quantifiable rules, not headlines. By logging each decision, she saw her annualized return stabilize above 12%, even when markets rocked from rate hikes to geopolitical shocks. Sector rotation calibration isn't about predicting the future. It's about engineering a process that leans into predictable patterns without paralyzing doubt. By marking one slot in your calendar, creating a rigid yet simple rule for reallocations, and auditing the process without ego, you turn sector rotation from a wishful concept into an ironclad habit. When next month's alert pings, you'll know exactly what to do. No hesitations, no regrets, just calibrated action that compounds over decades. Chapter 5. Behavioral Bias Journaling. He begins each evening by opening a simple notebook and jotting down the trades he made, the feelings that drove him, and the sparks of self-doubt or overconfidence that crept in. This nightly ritual feels almost too trivial to matter, but over weeks it reveals a hidden map of his mind's pitfalls. It is here, on these pages, that fear and greed leave their footprints. Every entry follows 3 clear rules: describe the trigger, name the emotion, and record the outcome. When the price slipped below his stop loss and panic tickled his chest, he writes, market dip at open, anxiety, sold early, missed rebound. Later, reflecting on this note, he sees a pattern. Sharp morning moves always rattle him. That single insight leads him to adjust his rule. Wait 15 minutes after market open before reacting. Another investor, Maya, shared how her journal saved her from her worst mistake. 2 weeks before an earnings report, she scribbled, "Noticing I feel overly optimistic because of recent wins." She underlined optimistic and forced herself to add a negative scenario. What if the company misses? That prompt helped her trim her position ahead of the surprise miss. By spotting and naming her own tunnel vision, she protected her profits. Actionable tip: whenever you feel a strong urge greed to chase gains or panic to cut losses, pause and write it down. Use a 1-sentence prompt like, "I feel because EO," then list 2 quick bullet points, 1 worst-case outcome, 1 best case. This simple habit creates a mental checkpoint that breaks the automatic chain from emotion to action. He learned another lesson when his friend Carlos cataloged his replay: bias, his tendency to replay winning trades in his head and forget the losers. Carlos started adding a 4th column in his journal titled Ignored Signals, where he briefly noted any caution signs he'd brushed aside: a rising debt ratio, a slowing revenue trend. Reviewing this column each week rebuilt his muscle memory for risk. To make journaling stick, it must live where you live your trading life. She set a recurring reminder on her phone and placed her journal beside her coffee mug. He taped a post-it on his monitor. Journal within 1 hour of market close. Within days, it became as automatic as logging into his trading platform. That physical trigger bridged the gap between intention and habit. A case study. Over 3 months, he compared his unjournaled months to the journaled period. His win rate climbed from 48% to 56%. More importantly, his average loss shrank by 20% because he caught his impulse to triple down on losers. This numerical proof turned journaling from a chore into a competitive edge. Complex behavioral science breaks down into 2 core concepts: awareness and accountability. The journal is your mirror for awareness, spotting the bias in real time. It is your accountability log committing to review and adjust. Without these side by side, you're flying blind or running in circles. He built a template sheet: date, ticker, trigger, emotion, action taken, ignored signal, lesson learned. That 7-field format takes under 2 minutes to fill and structures each thought. In the quiet of his home office, he knows he'll revisit these entries every weekend, scanning for recurring themes like overreaction to tech dips or underreaction to commodity spikes. If writing by hand feels slow, try a voice note on your phone. Just speak the same 7 fields into a note app and transcribe weekly. One investor recorded 3 hurried voice entries in a week and later uncovered that she never adjusted her stop loss when her portfolio gained more than 15%. That single insight stopped her next unintended drawdown. The power of bias journaling lies in its simplicity and its relentless self-examination. By turning fleeting feelings into concrete words, you transform gut reactions into data points. Over time, your journal becomes a playbook of personal tactics, the mental cues: when to hold, when to trim, and when to step aside. And here's the no-nonsense truth. If you skip journaling, you surrender your edge to the same biases that sink average investors. But if you commit even just 5 entries a week, you build a feedback loop that compounds like returns in a dividend aristocrat. The greatest investors don't outrun their emotions. They outright them. Make your journal your next habit and watch how the routine of reflection reshapes your results. Chapter 6. Continuous Learning Sprints. Every Friday at 5 p.m. sharp, he shuts his trading platform, silences his phone, and opens a fresh browser tab labeled Learning Sprint. In that 1-hour pocket of time, no meetings, no distractions, he pursues one clear goal: deepen his edge. This isn't vague self-improvement, it's a studio-style workout for his investing brain. He picks a single topic, say, interpreting a biotech earnings slide deck or mastering a new screening tool. And he commits to 3 rules: focus on one resource, take bullet point notes, and immediately apply one insight to his watch list. That discipline transformed his results. Within weeks, he spotted a pattern in clinical trial updates that others missed, locking in gains before the crowd even noticed the press release. He used to drown in newsletters, podcasts, and Twitter threads. Every day felt like drinking from a fire hose. Then he discovered the 3-question filter. What one metric moves my market? Where can I find it? How do I act on it? If a research report couldn't answer those questions in the first paragraph, he tossed it aside. For his first sprint, he chose a plain-spoken biotech blog with clear data tables. He read one post, jotted 3 takeaways: study size matters, regulatory timeline triggers price moves, volume spikes signal institutional interest, and spent the last 10 minutes scanning his portfolio for those patterns. That razor-sharp focus replaced overwhelm with confidence, and his error rate in speculative biotech plays dropped by half. Next, he downloaded a sell-side analyst report and treated it like a puzzle. He highlighted terms he didn't know, looked them up in minutes, and wrote definitions in plain English. When he encountered a chart showing earnings per share versus free cash flow, he paused to sketch his own version on a legal pad, forcing his brain to translate arcane lines into clear visuals. By the time the hour ended, he wasn't just reading jargon, he was fluent. He saved that annotated copy in a Sprint archive folder, tagged it by company and date, and set a reminder to revisit it before the next earnings call. That system made each sprint compound on the last, turning one-off insights into a growing library of strategic muscle memory. In another sprint, he tackled a new screening tool he'd ignored for months. He opened the interface, selected just 2 filters, price to earnings below 15 and dividend yield above 3%, and clicked Run. Then he challenged himself. Pick one ticker, look up its last 5 years of filings, and spend 5 minutes comparing management commentary to market reaction. When a pattern emerged, management optimism in late-cycle quarters often preceded a 7% price bump. He added it to a pattern cheat sheet. Over subsequent sprints, he refined his filters, swapped out bad screens, and even shared his cheat sheet with a friend in a WhatsApp group. That accountability turned a solo habit into a shared playbook, accelerating learning for both of them. He didn't stop with written reports. One week, he queued up a 30-minute industry podcast on automation in manufacturing. He listened at 1.5x speed, pausing every few minutes to summarize key points in his sprint journal. IoT adoption drives 10% efficiency. Chip shortages delay CapEx. Service revenue growth outpaces hardware. By sprint's end, he drafted 3 probing questions he'd ask management on the next earnings call. He found the act of framing questions more powerful than passively absorbing facts, because when he spoke, he forced his brain to connect dots, spot gaps, and anticipate the market's next move. He tracked progress like a coach. On Monday, he reviewed last week's notes. On Wednesday, he previewed this week's topic. By Friday, he executed the sprint. That regular cadence built momentum. Small victories accumulated over a month. He learned enough about semiconductor supply chains to reweight his portfolio ahead of a chip rebound, pocketing a 12% gain. Each success reinforced the habit, making it stick. By treating continuous learning as a ritual rather than an afterthought, he overcame the crushing feeling that there was too much to learn. Instead, he built a simple assembly line: select one resource, extract 3 insights, apply one action, archive the rest for future sprints. Over time, that deliberate 1-hour recharge didn't just sharpen his analysis, it rewired his confidence. And when a market shock hit, he didn't panic. He sprinted, turning learning into profit. Continuous learning sprints became his secret weapon, a repeatable habit that ensured he never outgrew his edge. Chapter 7. Portfolio Rebalance Rhythm. Every quarter, Javier slid into his home office chair, opened his trading platform, and treated his portfolio like a well-tuned engine in need of a checkup. He wasn't overthinking market noise. He was following a simple, repeatable rhythm. Listeners, imagine that same sense of control, knowing exactly when and how to realign your investments so you never drift off course. Javier's secret weapon was 3 clear rules. First, he set a recurring calendar reminder on the first Monday of January, April, July, and October. No excuses. His phone buzzed, his email pinged, and he showed up. Second, he defined specific drift thresholds. If any asset class stocks, bonds, or alternatives slipped more than 5% from its target weight, it was time to act. Third, he used limit orders to automate trades, so he never chased prices or suffered from analysis paralysis. He started each session by opening a simple spreadsheet that listed his target allocation: 60% equities, 30% fixed income, and 10% real assets. As he entered current values, the sheet calculated percentage drifts: instantly green meant within range, red meant rebalance required. Within 2 minutes, Javier could pinpoint exactly which slices of his portfolio needed topping up or trimming. Behind the scenes, these are the actionable steps Javier followed every quarter. Set the date. Block off 30 minutes on your calendar. No more, no less on a fixed quarterly date. Treat it like paying taxes, non-negotiable. Check your bands. Use a plus 5% tolerance band around each target weight. Anything outside that range triggers a rebalance. Prepare limit orders. Decide up front whether you'll buy or sell at what price. Enter orders immediately, no second guessing. When Sarah first heard about this process, her portfolio had drifted wildly. Tech stocks had swelled to 80% of her holdings after a run of big gains, leaving her vulnerable if the tide turned. She nearly missed the warning signs because she lacked a system. After adopting Javier's 3 rules, she held herself accountable. On her first quarterly check-in, she sold enough tech shares to bring that position back down to her 60% target, then used the proceeds to gently top up her bond fund. That single action saved her from stomach-churning volatility 6 months later, when growth stocks corrected by 20%. Javier and Sarah didn't reinvent the wheel. They built a habit so simple any listener could replicate: quarterly discipline, tolerance bands, pre-entered orders. Yet beneath that simplicity lay enormous power. By rebalancing, they bought low and sold high automatically, stripped emotion from their decision-making, and stayed firmly on track toward long-term goals. Actionable tip: use your broker's percentage of portfolio order type if available. Input the dollar amount needed to restore your target weight and let the platform handle it. If your broker lacks that tool, a spreadsheet is your friend. In one memorable anecdote, Javier described how he discovered a free online charting tool that visualized his asset classes like colored segments of a pie. One glance showed him tech was overfed and bonds were undernourished. That visual cue alone made him stick to his rebalance schedule. He'd never skip a quarter because he physically saw the imbalance. Listeners, you can find similar pie chart features in most robo-advisors or portfolio trackers. If you prefer pen and paper, sketch concentric circles indicating target versus current allocation. The act of drawing it yourself deepens the habit, your brain rewards consistency, and you build momentum. Let's break down a real-world example. On April 1st, Maria, an engineer turned part-time investor, logged into her account. She noticed her international equity slice had shrunk to 22% from its 25% goal. That 3% drift was within her band, so she moved on. Next, she saw her small cap fund sat at 7% against an 8% target again. No action needed. Until, finally, she saw the bond fund at 26% versus 30%. That 4% gap nudged her to allocate $2,000 of fresh cash directly into her bond ETF using a limit order at today's NAV. By acting only on positions outside the band, Maria avoided overtrading and minimized transaction fees. She spent a total of 7 minutes on her quarterly check. Then she closed her laptop and walked away, confident her portfolio was back in balance. This is the essence of the portfolio rebalance rhythm, a short, sharp habit that reinforces itself. You won't fix every market swing, but you'll harness them. You'll buy dips automatically and trim parabolic winners without regret. Most importantly, you'll shift from reactive trading to proactive habit. So, set your next quarterly date right now. Pick your tolerance band. 5% is a great starting point, and choose whether you'll use limit orders or a trusted spreadsheet. Commit to just one more habit. The confidence that comes from knowing your portfolio will never drift too far from your plan. With that, you transform occasional check-ins into a lifelong investing rhythm, simple, powerful, and unwavering. Chapter 8. Tax Efficiency Harvest Habit. He wakes before dawn on the first weekday of December, coffee in hand and portfolio app open, not to chase gains but to capture losses. In this quiet ritual, the investor turns tax season from a scramble into a strategic advantage. Every year, when markets dip and winners hide behind red ink, he leans in, hunting for positions that have underperformed but remain worth holding so he can sell, realize the loss, and immediately reinvest in a similar asset that keeps his allocation intact without triggering the dreaded wash sale rule. In one season, Amanda watched her tech-heavy portfolio slide 12%. Rather than panic, she flipped her mindset. December meant opportunity. She scanned each holding, flagged 3 with losses of 10 to 15%, and initiated sell orders on Monday morning. By lunch, she'd locked in a $7,500 loss. Before the market closed, she had reinvested in semiconductor ETFs with near-identical exposure. When spring brought a rebound, her tax savings enhanced overall returns by nearly 1.2 percentage points, a small victory that compounds over decades. He breaks the process into 3 simple steps, then repeats them each year like clockwork. First, he creates a loss candidate list in late November. Using his brokerage's reporting tool, he filters for positions down by at least 8%, excludes any he plans to exit for fundamental reasons, and highlights those still aligned with his long-term thesis. This automated report takes under 10 minutes to generate, saving hours of manual review. Second, he sets calendar reminders for the first 2 days of December. On day 1, he confirms the candidate list, double-checks any corporate actions or dividends that could complicate the sale, and places market orders to sell. On day 2, he identifies replacement assets, often a parallel ETF or a pooled fund in the same sector, and executes buy orders, ensuring he stays invested and ready to capture any rebound. One year, Michael overlooked the wash sale rule when he sold his small-cap healthcare fund and repurchased a nearly identical one 2 days later. The IRS disallowed his loss, costing him a $2,300 deduction. He learned the hard way, but adapted by picking replacement funds with subtly different holdings, swapping one mid-cap fund for another with only 60 to 70% overlap. It added a minor tracking error, but protected his tax harvest. The third step is documentation. He saves trade confirmations and annotates his loss harvest log with dates, ticker symbols, share counts, and cost basis adjustments. Come tax time, his CPA simply plugs in the numbers. No frantic emails, no last-minute downloads. The entire file sits neatly in his tax loss harvest folder by January 15th. Reducing stress and eliminating missed deadlines. Building this habit transformed Amanda's annual routine. What used to feel like a chore became a chance to improve her after-tax returns by up to 0.8% each year, an amount most investors overlook. She even turned it into a friendly contest with her mentor, who challenged her to find one extra loss candidate each December. That little game sharpened her research skills and kept her engaged, turning tax planning from dull paperwork into a strategic hunt. He reminds himself that losses aren't failures, they're currency. By harvesting them intentionally, he offsets ordinary income or capital gains elsewhere, keeping more money in his pocket. Over 10 years, these small annual tax savings have stacked into a sum that rivals the yield of a high-dividend stock. To make it stick, he ties the ritual to an existing habit. December's household budget review. After reconciling his personal finances, mortgage, utilities, holiday gifts, he pivots to his investment spreadsheet. The trigger is the same calendar alert. Review tax loss harvest. This piggyback approach cements the habit, so it runs on autopilot amid the holiday rush. Real-life investors report that consistency matters more than perfect timing. If markets rally sharply in early December, capturing smaller losses still works. These micro-harvests add up. He once netted over $1,200 of total write-offs by selling minor positions already flagged by his scanner, even though each loss was only a few $100s. Taken together, they funded his family's holiday bonus without touching his regular savings. By January, the process is already behind him. He files his Schedule D with confidence, knowing every transaction is documented and every rule respected. The habit frees him to focus on opportunities, not paperwork. He no longer fears red days. He welcomes them because they fuel next year's growth. This chapter leaves listeners with a clear blueprint. Build a concise list of loss candidates, schedule a December ritual to sell and replace, and document everything. Anchor it to an existing habit. Keep replacement assets sufficiently similar but not identical, and watch small losses evolve into large gains over time. With the tax efficiency harvest habit in place, the investor turns a dreaded tax chore into a cornerstone of long-term success, proving once again that disciplined routines, not one-off decisions, compound into financial freedom. The end. We hope you've enjoyed the audiobook. This audiobook is a production of WealthBooks, copyright 2025.